In 1950, a young man from Omaha, Nebraska walked into a bookstore and picked up a copy of a book that had been published the year before. He was 19 years old. He had already been investing for several years, buying stocks, tracking prices, following tips from newspapers. He thought he knew what he was doing. He read the book in one sitting. He later said it was the best book about investing ever written. He called the author the second most influential person in his entire life, after his own father. That young man was Warren Buffett. The book was The Intelligent Investor by Benjamin Graham. Buffett did not just read this book. He studied under its author at Columbia University. He went to work at Graham's investment firm. He built his entire investment philosophy on the principles in these pages. And those principles, applied consistently for 7 decades, made Warren Buffett one of the wealthiest people in the history of the world. Today, I am giving you the complete summary of The Intelligent Investor, the book that Warren Buffett calls the best investing book ever written. Every major concept, every key lesson, in one sitting. Welcome to Money Mastery Books. Let's begin. Lesson 1. Investment versus speculation. Know which one you are doing. Benjamin Graham opens this book with a definition, a very specific, very important definition that most people who call themselves investors have never actually thought about. He says, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Read that again slowly. Thorough analysis, safety of principal, adequate return. If you are buying a stock because someone on social media said it was going up, that is speculation. If you are buying a cryptocurrency because you are afraid of missing out, that is speculation. If you are buying a stock because the price has been rising and you expect it to keep rising, that is speculation. None of these things are wrong necessarily, but Graham insists you must know what you are doing, because speculation and investment require completely different mindsets, different risk tolerances, and different outcomes. The investor does not try to predict what the market will do tomorrow. The investor analyzes the underlying business, its earnings, its balance sheet, its competitive position, and buys it when the price is less than its actual value. The speculator bets on price movements. Sometimes they win, often they lose, and they almost never beat the patient investor over the long run. Graham's first lesson is the most important. Decide what you are, an investor or a speculator, and then behave accordingly. Lesson 2. Mr. Market, the most powerful metaphor in investing. If there is one idea from this book that every person who owns a single stock should understand, it is this one. Benjamin Graham asks you to imagine that you own a small share of a business, and every single day your business partner, a man named Mr. Market, shows up at your door and offers to either buy your share or sell you more. Some days, Mr. Market is wildly optimistic. Business is booming, he says. The future is bright. He offers you an enormous price for your share. Other days, Mr. Market is deeply depressed. The economy is terrible, he says. Everything is falling apart. He offers you a very low price for your share, and he is desperate to sell you more of his. Here is the key insight. Mr. Market's prices are real. You can act on them, but you are never required to. You can ignore Mr. Market completely on the days when his prices seem disconnected from reality. You can buy from him when he is panicking and prices are low. You can sell to him when he is euphoric and prices are high. Or you can do nothing at all and simply watch him come and go. But here is what most investors do instead. They let Mr. Market's mood determine their own mood. When he is optimistic, they feel optimistic and buy at high prices. When he is panicking, they panic and sell at low prices. This is exactly backwards. Mr. Market is your servant, not your guide. His job is to offer you prices. Your job is to decide whether those prices make sense based on the actual value of the underlying business. When the stock market falls 30%, as it does periodically throughout history, Mr. Market is not telling you something terrible has happened to the companies you own. He is offering you a sale. The same businesses you owned yesterday are available today at a 30% discount. The intelligent investor does not panic when markets fall. They go shopping.
Lesson 3. The marring of safety. The 3 most important words in investing. Graham calls the margin of safety the central concept of investment. It is also, in my view, the simplest and most practical idea in this entire book. The margin of safety is the gap between what you pay for something and what it is actually worth. Imagine a business that is genuinely worth $100 per share. If you can buy it for $70, you have a $30 margin of safety. If your analysis of its value is wrong, if the business is actually only worth $80, you still paid less than it is worth. You are still okay. But if you pay $120 for a business worth $100, you have no margin of safety. If your analysis is slightly wrong, you lose money. If the market turns, you lose money. If anything unexpected happens, you lose money. The margin of safety is your protection against being wrong. And Graham is very clear about this. You will be wrong. No matter how careful your analysis, the future is uncertain. Businesses change, economies shift. Things happen that no one predicted. The margin of safety does not require you to be right every time. It requires only that you buy at a price low enough that even when you are wrong, the damage is limited. This is why Graham says the most dangerous words in investing are, "This time it's different." Every time investors convince themselves that normal rules do not apply, that prices can keep rising forever, that a new era of permanent prosperity has arrived, they abandon the margin of safety. And they pay for it. Pay less than something is worth. Always, without exception. This is the margin of safety, and it is the foundation on which every great investment is built. Lesson 4. The defensive investor versus the enterprising investor. One of Graham's most useful contributions is his recognition that not all investors are the same, and that different investors should follow different strategies. He describes 2 types. The defensive investor, also called the passive investor, is someone who wants reasonable returns with minimal effort and minimal risk. They do not want to spend significant time analyzing individual stocks. They want a simple, reliable approach that they can follow without stress. For the defensive investor, Graham's prescription is straightforward. Own a diversified portfolio of high-quality stocks and bonds. Rebalance periodically. Do not try to time the market. Do not chase hot stocks or exciting opportunities. Own the whole market through index funds if possible, and then leave it alone. The enterprising investor, also called the active investor, is willing to put in the time and effort to find and analyze individual investment opportunities. They want to beat the market average, and they are prepared to do the work that requires. But Graham is direct about something that most people do not want to hear. The enterprising investor should only try to beat the market if they genuinely commit to doing the research properly. A half-hearted effort at active investing is more dangerous than simply doing nothing and owning index funds. Most people, Graham argues, are better served by being honest with themselves, admitting they do not have the time, knowledge, or temperament to pick individual stocks successfully, and simply being excellent defensive investors instead. There is no shame in this. The defensive investor who consistently invests in low-cost index funds and never panics will outperform the majority of people who try to be clever about individual stock selection. Know which type you are, and then commit fully to that strategy. Not the one you wish you were, but the one you will actually follow. Lesson 5. Price and value are not the same thing. This is the idea that runs through every page of this book, and it is an idea that most investors, even experienced ones, struggle to truly internalize. The price of a stock is simply what someone is willing to pay for it today. The value of a stock is what the underlying business is actually worth, based on its assets, its earnings, its competitive position, and its future prospects. These two numbers are related, but they are almost never identical, and in the short term, they can diverge wildly. In a bull market, when everyone is optimistic, prices rise far above values. People pay enormous amounts for businesses based on hope and excitement rather than on the actual numbers. In a bear market, when everyone is fearful, prices fall far below values. People sell good businesses at terrible prices because they are panicking. The intelligent investor's job is to know the difference. Graham spent his career developing tools to estimate the intrinsic value of a business, the price-to-earnings ratio, the price-to-book ratio, the earnings yield. These are not perfect measures, but they provide a rational framework for deciding whether a stock is expensive or cheap relative to what the underlying business is actually producing. The key insight, one that Graham returned to again and again, is that the stock market in the short term is a voting machine. It reflects sentiment, enthusiasm, fear, and momentum. But in the long term, the stock market is a weighing machine. Eventually, it reflects the actual value of the underlying businesses. Buy good businesses at prices below their value. Be patient. Let time and compounding do their work. The market will eventually recognize what you already knew. Lesson 6. The investor's chief problem is themselves. In one of the most important passages in this book, Benjamin Graham writes something that sounds simple but cuts to the heart of why most investors fail. He says, the investor's chief problem, and even their worst enemy, is likely to be themselves. Not the market, not the economy, not bad luck or bad timing, themselves. This is because investing requires you to do things that feel deeply unnatural. It requires you to buy when everyone around you is panicking and selling, to hold steady when markets are falling and every headline is predicting disaster, to resist the excitement of a rising market and the fear of a falling one. It requires patience over periods of time, sometimes years, when nothing seems to be working. It requires ignoring the noise of daily market movements and keeping your eyes on the long-term value of what you own. These things are easy to describe. They are extraordinarily difficult to actually do, because they go against every instinct we have. When prices are falling, every part of us wants to sell. When prices are rising, every part of us wants to buy more. Graham's prescription? Create a written investment plan before you start. Define exactly what you will buy, at what prices, and in what circumstances. And then follow that plan, regardless of what the market is doing, regardless of what the news is saying, regardless of what your emotions are telling you. The plan does not have to be complex. It has to exist, and you have to follow it. Because the investor who can control their emotions, who can be greedy when others are fearful, and fearful when others are greedy, will always outperform the investor who lets the market tell them how to feel. Lesson 7. Dollar-cost averaging, the simplest strategy that works. After all the complexity of value analysis and margin of safety, Graham offers something surprisingly simple for the average investor. It is called dollar-cost averaging, and it is one of the most powerful and underappreciated strategies in personal finance. The idea is this: instead of trying to find the perfect moment to invest, instead of waiting for the market to fall or worrying that you are buying at the wrong time, you invest a fixed amount of money at regular intervals, regardless of what the market is doing. Every month, on the same day, you invest the same amount. When prices are high, your fixed amount buys fewer shares. When prices are low, your fixed amount buys more shares. Over time, this naturally results in buying more shares at lower prices and fewer at higher prices. It removes the need to time the market. It removes the emotional decision-making. It removes the anxiety of trying to pick the perfect moment. Graham calls this one of the most sensible strategies available to the individual investor, not because it produces the highest possible returns, but because it produces consistently good returns with consistently low stress. The key word in that sentence is consistently, not brilliantly, not dramatically, consistently. Consistent investing over decades with reinvested returns in a diversified portfolio is the strategy that most people can actually follow. And the strategy people actually follow almost always beats the strategy they only follow sometimes.
The core message.
Benjamin Graham wrote The Intelligent Investor in 1949. He revised it in 1973. And despite every change in markets, technology, and economic conditions since then, the core lessons remain unchanged. Because the core lessons are not about the market, they are about human nature, and human nature does not change. Know the difference between investment and speculation, and know which one you are doing. Understand that Mr. Market is your servant, not your guide. His daily prices are offers, not instructions. Always demand a margin of safety. Pay less than something is worth, without exception. Know whether you are a defensive investor or an enterprising investor, and commit fully to the strategy that matches who you actually are. Remember that price and value are different things. In the short term, sentiment drives prices. In the long term, value wins. And finally, understand that your greatest investment challenge is your own emotions. Build a plan. Follow it. Do not let Mr. Market, or the news, or your friends, or your own fear make your investment decisions for you. Warren Buffett has said many times that 2 chapters of this book, the chapter on Mr. Market and the chapter on the margin of safety, contain more practical investment wisdom than anything else ever written. I believe he is right. The Intelligent Investor is not a book about how to get rich quickly. It is a book about how to avoid getting poor stupidly, and how to build real, lasting wealth through patience, discipline, and rational thinking. As Graham himself wrote, "The intelligent investor is a realist who sells to optimists and buys from pessimists." That was the complete summary of The Intelligent Investor by Benjamin Graham, the book that Warren Buffett has called the best investing book ever written. If there is one idea I want you to carry from this video, it is the margin of safety. Whatever you invest in, pay less than it is worth. Build in a buffer. Protect yourself from being wrong. Because in investing, as in life, being wrong is not a possibility. It is a certainty. The only question is whether you were protected when it happened. Here on Money Mastery Books, we release a new full audiobook summary every week. We have done full summaries of The Psychology of Money, Think and Grow Rich, Rich Dad Poor Dad, and The Millionaire Next Door, all linked in the description below. If this video gave you value, please subscribe and share it with someone who is trying to figure out how to invest their money without losing it.
Until next time, keep reading, keep building, and remember, in the short run, the market is a voting machine. In the long run, it is a weighing machine. This is Money Mastery Books. We will see you in the next one.